Hello, this is Jay King, self-made millionaire, coming to you from MillionairePennyStocks.com. I want to congratulate several of my students that bought BGI. We alerted several of our students at around 134, 150 between that price range. And this particular stock went all the way up to 515. Now keep in mind, guys, when you're playing these breakout stocks and earnings winners, when these stocks enter into new heights, this is not something that happens all the time. Stocks do break out, but you don't see companies that go from 60 cents to $5 to 10 to 20 bucks. There are only a handful of stocks that do this yearly. And so it's good when you can get in on plays like this. I don't suggest that you develop a core strategy of looking for breakouts when you're building a small account, because that's not the strategy that's going to grow a small account. But it is good if you can get in on some of these plays. But the reason I say that is because understand, when people show you these breakout plays, a lot of times, guys, we have to enter into 3, 4, 5, 6 other trades that might not work for us or might not break out. So we have to enter in and exit. And keep in mind, every time you enter a trade and you exit, depending on what broker you're using, you're paying a commission. So let's just say if the only strategy that you use is you look for breakouts. Well, if you enter into a stock and it doesn't work for you 20 times, you just spent about $15 to $20 worth of commission fees. So you're at $400 that you've already spent. So I don't suggest that you develop a strategy of always looking for breakouts, but I do say that once you decide to play a breakout, go for it. But understand there are other methods, there are other strategies that you need to develop. And one strategy that I think is really good for growing a small account is waiting for stocks to break out and then wait for them to dip and consolidate throughout the day. Once stocks slow down a little bit and you're able to get in with a good entry on a dip buy, these are really good strategies to grow an account. Let me give you an example. Today we shorted Twitter at 17.16. We only shorted about 500 shares, and I think I covered at about 16.82, 16.83. And this was a wonderful execution on our trade. If you look real closely, you can see here, this is our premium account that I'm trading with. So yes, you can see here I shorted 500 shares of Twitter at 17.16, and I covered at 16.85. Now this went all the way down to 16.76 for the actual day low, and it found support at 16.76. And when we say support, we're just saying a stock will not drop below that price, and that's its foundation for the day. And I tried to dip by this at around 16.80, another 1,000 shares around 16.80, 16.81, because remember, I'm showing several of you how to build a small account. Our premium account, we started off with 30,000, I think between 30,000, 30,500. And so you see now we're up, and we're up about over $1,500. And I'm placing small trades. Today, TVIX, I went in at 214, 750 shares. And if you look at TVIX, TVIX is a wonderful, obvious stock that I play. I call these obvious patterns. And when you look at the historical quote for TVIX, it's been known to spike really big. See here, it opens up. Let me show you a play. It opens up at, let me see, we'll find something, 250 right here. And the next day it spikes all the way up to 348. But notice it spikes to 370. We have 378 here, 368. So it's been known to really spike big. So today what I did on this particular play is I played the breakout. And it did really good at first, but it could not break past 219, 220. Got all the way up to 222. But we noticed in the history, if you look at the history, when this stock gets really big and it breaks out big, notice the volume goes from like 60 or 70 million, because that's the average volume, to all the way to 130 million. Notice that. When you see the big 100 million volume plays, it spikes really big. So notice when this stock, the volume starts to increase on it, this is a pattern, we begin to see a big increase in its volatile spread. So I'm going to wait, and I'm still looking at this stock. This is on top of my watch list. It hasn't broke below 203, but the good news is that's the all-time low, and it's found support at around 205, 206. And so we'll see if we can spike. This particular stock can spike up to about 260, 280, 290. But if it breaks past maybe 223, 224, I may get in again and try to ride up that particular breakout on that train. But also too, I wanted to congratulate everyone on BGI. This was a wonderful trade. Several of you banked on this particular stock, several of my students. I did not get in on this trade, but I did alert several of my students at 134, between 134 and 150, concerning this particular play. And this was a good play. I mean, this stock really broke out into new heights. Again, if you look at the history, we see the history of this particular play. May the 10th, you see it's at 50 cents. But notice in June, notice that it ranged between 45 cents and 50 cents. And when I'm looking at this, I'm looking at the day lows and the day high. But what I want you to notice is, remember what we focus on: price action, momentum, volatility, and volume. Notice when the volume increases. The neat thing about this is when this trade started to merge up, the volume was at 400,000, and all of a sudden the momentum started to build. And when it got up to around $1.50, $1.60, we started to see it go up to 800,000, and then it broke a million. And before you know it, the momentum just pushed the volume up, and the price action was there. And you could have played the breakout on this particular play. And what I mean by playing the breakout is, when you go into a stock, you have to have goals before you enter into a trade. Always remember that. You want to have goals. Now we're looking at the after hours, so this is starting to merge back up during the after hours. But you want to go into a trade with goals. So if I go into a trade and I want to play the breakout, then what I'm going to do is, in the morning, I always suggest, if you're building a small account, don't buy a lot of shares when you're playing the breakout, because a lot of times stocks that break into new heights are very volatile. So if you have a small account, I would play anywhere from 100 to 500 shares on the breakout and just hold. Like, for instance, if you would have bought this particular stock at $1 and you would have just spent 200 shares, or you would have just spent 200 bucks, well, that will only cost you, what would that be? 200 bucks. That would have been what, 100 shares at $2, and it went up to $5. You would have had a $4 upside on that particular trade, which would have made you $400. But think about it. If you enter into a stock at $1 with 200 shares, let's just say 200 shares, and that stock goes down maybe 20 cents, well, you only lost $40 on that particular trade if you decide to exit. But the upside potential can be very much greater than a negative $40 loss. So when you enter into trades like this, understand that these aren't the type of trades that's going to build an account, because you don't know when stocks are going to break out. That's the whole goal. You have to get into a stock and discipline yourself and use fundamentals and say, I'm going to play this breakout because this particular stock is an earnings winner. And earnings winners, remember, always have more of a chance to break out than just the regular stock that has not reported any earnings. Always remember that. So me personally, I like to play stocks that are volatile on a day-to-day basis. Every once in a while, I would choose to play an earnings winner if it meets my criteria. But in building a small account, playing earnings winners are not the best route to go, because you cannot really define a core strategy every day. But what I like to do is I like to dip buy stocks that have obvious patterns. I like to look at charts. I like to short into very aggressive spikes. A lot of stocks today, we saw that Twitter was in the 1750 range on Friday, and it couldn't break 1750. So during pre-market, I saw this begin to gap down, and I know Twitter is probably going to go back in the 16 and 15 range. So this was a good short today on Twitter. But again, I wanted to encourage you, and I just wanted to do this video lesson because I wanted to show you that when you're developing a strategy as it relates to trading, it's wonderful to get in on these breakouts, but don't just look for breakouts. Look for stocks that are volatile. Like this particular play, a dip buy would be, for example, if this stock goes from 60 cents to 5.15, I'm gonna give this stock time to consolidate, because this stock is moving too fast. If you looked at this stock around 9, 10, 11 o'clock, it really wasn't the best time to get entry on this particular trade, because you didn't know where it was going. For those of you that did get an entry, congrats. But this is not your normal daily activity. But this particular stock, it dropped all the way back down to 250, 260. So we see that would have been a good dip buy, because you're identifying that this particular play is an earnings winner. But now you're able to dip buy it. Dip buying just means you buy it below the resistance level. You buy it below the price where everyone else is buying. See, this is the whole key about dip buying. If you can get a stock lower than what everyone else is paying for it with great volume, it's going to give you more support and you have more of a chance of getting a 30 to 50 cent spread. It's just like if you go to um, the store and you want to buy, you want to buy a game system. I have several kids that love video games, and I always use this as an example. If PlayStations are $800, then I'm going to wait to get them at a discounted price. I want to buy those PlayStations for 200 or 300 instead of 800. And so if I buy Xbox right when it comes out, it's going to be too expensive because the retail price is going to be too high. But if you can just be patient and you can wait for that discount, it's going to drop from $400 to about $200. But you have to be patient. So that's how stock is. When stock goes from 60 cents to 5.15, if you can just be patient, if you're looking to buy and wait for it to consolidate, wait for it to drop down a little, you're going to have a lot of sellers that are emptying their shares. And once it consolidates and it finds support and it slows down, enter into the trade. Now, once you enter into the trade, accept the fact that you've entered in at 268. And if I enter into a trade at 268, I already know if that trade goes to 265 or 260, I'm going to cut my losses. My whole goal is to enter into a trade with rules, with strategy, have my goals already set. I know what my entry points are, and I know where I'm going to exit the trade. And if the trade works for me, I'm going to maximize my profit. But if it doesn't work for me, I'm going to minimize my losses. And this is the whole key to trading with discipline and skill, is to enter into trades with goals, with rules. And if the trade doesn't work out for you, you learn to exit the trade. And that's the meat and the foundation of trading, is when you enter into these trades, you know why you're entering into this trade. I'm trading this particular play because it's an earnings winner and I'm playing the breakout. If this particular play, if I enter in at $1 and it doesn't break 120 or 130 or 115 and it stays there for a while and it's not breaking out, I'm not going to hold on to the stock. I'm going to go ahead and exit the trade because my goal was to sell it at 150 or 160. But if I buy it at $1 and it goes down to 95 cents, I already had in my mind before I entered into the trade that if that stock goes to 97 or 96 cents, I am out of there. I'm exiting the trade because what I want to do over a period of time is I want to practice discipline. I want to practice minimizing my risk as it relates to trading. So this is really important for us to understand. If we're going to grow our consciousness as it relates to trading, and we're going to understand how to trade with skill, we're going to have to develop a strategy. The greatest strategy, I believe, in this type of market is dip buying. And the reason I believe dip buying is important is because you're able to identify first which stocks have a spread. And this particular volatile spread just simply means this is a stock we identify that has a spread. Now remember, when these stocks run on the first day, maybe the first 1 or 2 days, that's the best time to dip buy, because after 2 or 3 days, usually they're going to lose momentum and they're going to start to decline in price. And most stocks that are $3 or $4, $5, $2, most of those stocks cannot hold their position, and normally they're not going to go to 7, 8, 9, 10 bucks. They're going to decline in price eventually. But that's another story. That's another strategy when you can learn how to short stocks after 3 or 4 days. Once they lose their momentum, you can get in and you can bet against those plays. But I want you to understand in these breakouts that when you're looking for stocks that are breaking out into new heights or earnings winners, these are not your typical plays that happen all the time. So you have to enter into some trades, and when you enter in, a lot of times you're going to have to jump right out of them because those trades didn't break out. And I want to tell you that because a lot of times you'll see people showing you the stocks that really did well, but they don't show you all the trades they had to enter into and exit because those stocks didn't break out. So it's just a matter of staying engaged and looking at the market, because there's several trades that I enter into sometimes that I don't necessarily lose a lot of money because I minimize my risk on each trade, but they just don't meet my goals and they don't work out for me, and I don't get a BGI experience. But you know what? If I can get a 5 or 10 or 15 cents upside on the trade, then a lot of times I take it, because the name of the game is learning to eat the elephant piece by piece. If you're greedy and you don't know how to trade with discipline, you're going to try to get these big gains, and big gains lead to failure. And the reason why is you're not going to grow an account on big gains, because big gains are not the best way to build a brokerage account. The best way is to take small profits. Take your $50 profit, take your $120 profit, take your $300 profit. And I want you to learn to develop a trading strategy that teaches you how to develop small profits. Now, what we talked about today is dip buying is very important. Now, these particular companies aren't as established, but the reason why I showed you Twitter is Twitter is a company that I short a lot. I short this, I bet against this stock a lot, and I wait for it to hit resistance. That just simply means it hits a day range that it can't pass. When a stock hits resistance, it's like hitting a wall, hitting a ceiling, and you begin to see that the stock cannot go past a certain price. And so now you short it or you bet against it, and you benefit from the decline on the stock. And so the thing is, today, remember, we're talking about understanding certain methods of trading, understanding shorting, understanding technical breakouts. These are strategies that can help you become better. But the key is learning to trade with discipline. And again, we did wonderful today. I mean, I didn't really trade as much today. I traded today out of our premium account, and I only made 2 trades. And I exited this trade. I think on this particular trade, with commission, I may have lost like $6 or $7 because I sold at 214 or 215. So I probably lost about $8, but I covered that on the trade that I made with Twitter. So today I probably made about $138, $139 on the premium account. And so that's a good day today. I wasn't as aggressive today as I normally am, but we had a good day today and we profited. So again, this is Jay King, Self-Made Millionaire, showing you how to trade with $30,000. You start small and then you build over a period of time. You learn to minimize your risk. When you're wrong about trades, you exit the trade. When you go into a trade, always go in with goals. Know why you're buying the trade and know what method you're using. And if that trade works for you, then you can maximize those profits. But if those trades go against you, then the best thing to do is minimize your risk. The whole key in trading is learning to keep your risk minimized. Some people set stop losses and some people don't. If you set stop losses, that's good if you set stop loss. If you don't set a stop loss, it's no strain on the brain. The whole goal is, in your mind, you need to set a mental stop loss and understand the importance of keeping your risk minimized. Now, when you minimize your risk, what eventually ends up happening is you save yourself from catastrophic losses. Many of us as traders, we've had catastrophic losses, but many of us, we have bounced back because we understand the importance of trading with rules. This is again Jay King, Self-Made Millionaire. Have a wonderful day. Thank you.